Picture a thriving manufacturing plant. The assembly lines are running around the clock, orders are pouring in, and the owners are popping champagne over record-breaking multi-million-dollar profit margins on paper. Fast forward exactly 10 years. A critical gear snaps inside the main facility. The assembly line grinds to a sudden halt. The owners go to order a replacement, only to look at their bank accounts and realize there is absolutely no cash left to buy a new one. The business collapses overnight. This collapse was caused by a silent financial killer. The company forgot to account for depreciation. To understand why this happens, we have to look at tangible assets, often called property, plant, and equipment. These are the physical items a company holds for production, rental, or administration, and expects to use for more than 12 months. Because a major piece of machinery lasts much longer than a single accounting year, a business cannot simply deduct its massive price tag on day one. Instead, it must spread that cost out, matching a fraction of the expense against the revenue the machine generates every single year. Assets lose their value in 5 distinct ways. There is the obvious wear and tear from daily use, the passage of time, even when sitting perfectly idle, technological obsolescence, a drop in overall market value, and the natural depletion of resources. This source chart outlines the main objectives for tracking this decay. These goals ensure the company determines the true results of operations, presents an accurate financial position, and, crucial to our bankrupt factory, accumulates enough funds to replace the asset when it dies. Accounting for depreciation forces a business to acknowledge the expired cost of its equipment, creating a capital reserve for the eventual replacement of those machines. Under the Companies Act of 2013, depreciation has a strict legal definition. It is the systematic allocation of an asset's depreciable amount over its useful life. This visual equation shows the calculation. We start with the initial cost block. By subtracting the estimated residual value, the predicted scrap value, we are left with the depreciable amount. We then stretch that amount across the timeline of its estimated useful life. There is a common trap here. The clock on this timeline starts the moment the asset is in the location and condition necessary for its intended use, known as the available for use rule. It does not wait for you to actually flip the power switch. Consequently, a multi-million-dollar piece of equipment sitting in a warehouse is actively bleeding value from the company's balance sheet day after day. Accounting standards also enforce the component rule. If a single large asset is built from significant parts that have entirely different lifespans, accountants are required to depreciate those individual pieces separately. Take a look at this commercial aircraft. On the balance sheet, it exists as a collection of separate parts: the airframe, the jet engines, and the passenger interior, each with a different individual useful life. They each get their own separate countdown timer. Treating a complex machine of this scale as a single unit masks the true rate of its physical decay. If you don't track the engines separately from the frame, you will severely distort the company's reported profit. When it comes to actually dividing up that cost over time, accountants have options. The straight line method writes off an equal flat amount of value every single year until the asset hits zero or its final scrap value. Contrast that with the reducing balance method. Here, the company charges a high amount of depreciation in the early years and less as the machine ages. Under this math, the asset's book value never actually reaches absolute zero. This mathematical breakdown shows a variation called the sum of years of digits method. The remaining life of the asset is divided by the sum of all the digits of its total life, creating a front-loaded fraction that multiplies against the depreciable amount. This split graph shows the real-world impact of these choices. On the left, straight line features a flat depreciation charge, but as the machine ages, repair costs rise, meaning total costs skew higher late in life. On the right, the reducing balance method matches high early depreciation with low early repairs, combining to form a stable, flat total cost over the entire lifespan. A company's choice of mathematical method dictates the exact amount of profit reported to investors each year, making the selection of SLM or WDV a strategic financial lever. This logic extends far beyond factory machines. For natural resources like oil, gas, or timber, we use depletion. The cost of the mine or the well is divided by the estimated quantity of the resource we can actually extract. Then there is amortization. This applies to intangible assets, things like custom software, patents, or copyrights that lack physical form but still lose value over time. Because technology evolves so quickly, there is a strict presumption for intangibles. Unless a company can prove otherwise, the useful life of an intangible asset is presumed not to exceed 10 years before it becomes obsolete. But what happens when reality breaks the math? Imagine a heavy-duty machine is scheduled to last 10 years, but a sudden leap in industry technology makes it worthless in year 4. The accountants don't go back in time and rewrite the past 3 years. Instead, they take the current written-down value of the asset and simply spread that remaining amount over the newly revised, much shorter timeline. Depreciation, depletion, and amortization act as truth-telling formulas. They align financial records with the physical and technological realities of the industry, ensuring the business retains enough cash to survive. Yet all of these timelines eventually come to an end. So what happens the day an asset is finally sold or dragged out to the scrap heap? How do you calculate the ultimate profit or loss when an asset dies?